Welcome everyone. I'm really sorry for the slight delay, but having come from Cambridge, first train was cancelled. District line, as many of you I'm sure will be late as well as a result, was all over the place. And now even the microphone was refusing to work. So I'm really sorry for that delay, but I'm going to move here forward. My name is Gonçalo. I'm a CEO and co-founder of Syndicate Room. And Syndicate Room is an online investment platform that allows people like you and I to invest alongside professional investors. And that's all for equity. So we don't do any debt, we just do equity. And we allow, the whole vision behind Syndicate Room when I started the company was about, shouldn't really matter whether you're investing £1,000 or £1 million. Everybody should have access to the same deals, the same transparent information, and the same risk and reward. Meaning that it doesn't really matter whether you invest £1,000 or £1 million. On a pound per pound invested, everybody should make or lose the same amount of money. So when we started the company, so we launched just over 4 years ago, and crowdfunding back then was very nascent. It had been around for about 2.5 years, and it was very far from what it is today. The perception and the acceptance of online investment was miles away from what it is today. I mean, I still record me trying to raise money from business angels and VCs, and I'm saying, Gonçalo, don't be silly. No one will ever invest online. Right? And if you think that today, it sounds absolutely ridiculous, but the fact was, in their own industry, in their own field, and not that long ago, just 4 years ago, they were still claiming that no one would ever invest in early stage companies online. And that, of course, has changed a huge amount as a crowdfunding and online investment online has really evolved a very significant amount. The evolution of crowdfunding went from, at the very beginning, from just crowd, like £10 investors, what the FCA now calls restricted retail investors. And it has evolved along the years as the offer of which opportunities are available for investment have evolved as well. So more and more sophisticated investors have joined the party, business angels, and now even VCs. VCs are constantly on the lookout for these platforms, Syndicate Room and others, in order to find deals that they want to invest in. And the investment by the VCs still, by and large, takes place offline, but the whole interaction takes place online, and then there's usually the normal sort of coffee with entrepreneurs and part of their due diligence. But that's really evolved a huge amount since just a £10 crowd investor to where it is today. And it has evolved in such a way that now it's not just about early stage companies. Now it's also about, it's all the way from idea, all the way up to IPOs, right? And not all platforms do it, but now it's really starting to become the norm that IPOs do sit side by side with companies that are only raising £150,000 under SCIS scheme that are very, very early stage. Now, the principles of the investment haven't changed, and that's really good to see, right? Because that's really important, because they've been around for long enough, and they really shouldn't change. It's really the use of the technology that has made it far more efficient, and that goes well beyond what it used to be, that it was just to be a campaign, raise money, off you go. Now it is really pre-campaign, getting the interest from customers, getting the interest from people that already know the company for one reason or another. Then during the campaign, the shared due diligence. I mean, for those of you that are entrepreneurs and have had to go through this process, you know exactly what I'm talking about, that you keep on answering the same questions over and over and over and over again. Whereas with a platform, what you do is someone asks the question, because everybody can read the question and the answer. What that means is that effectively it becomes far more efficient. You don't have to answer the same question over and over and over again. You just answer it once, and then you can refer back to that answer. But the way I see fintech really changing crowdfunding, or crowdfunding giving that huge jump, that's really going to be the game changer, is as these platforms become data platforms. So they don't become just a place to raise finance. They become data platforms. Now think about it. Syndicate Room it operates in a different way to crowdfunding, and yet it still has about 120 companies in its portfolio, and adding 1 to 3 every single week. Other platforms have in the hundreds and hundreds of companies already in their portfolio. That gives platforms data that no VC, no business angel, no association of, be it Venture Capital Association or the UK BAA, the Business Angel Association, has access to. And that's really where I think that the game changer is going to be in this class, in this asset class. Because if you think about having access to that much data in a structured way, what it means is that you can start identifying patterns that result in better outcomes. What does this mean? This means that platforms can start identifying which type of investments, which causes relate to, obviously, a successful exit. And in my mind, that is an absolutely crucial change. Because suddenly, you can break so many barriers. And for those of you in the VC industry, you will understand exactly what I'm talking about, which is you can break the barrier, for example, of these incredibly annoying buyers towards middle-aged, white man, just like myself, right? And that really, that is really going to change a lot of barriers, because that it will change how the venture capital as a whole is going to get distributed. It's going to get distributed on a much more related to the likelihood of success, rather than because that person looks just like me and therefore I like that person more and therefore I'm going to choose to invest into that company. So that sort of bias, I think it will really disappear the moment you start applying data, and the moment these platforms become data platforms and really data-driven. And that takes me to the second thing, which is automated investment. If you have the data, if you have the likelihood of the outcome, then why wouldn't you do automated investment? And that, in many ways, that's what we started, although very far from being where I envisage it to be in 3, 4, 5 years' time, where we'll have far more data, particularly on the outcomes, which is automated investment by a fund. So in this case, Syndicate Room has a fund called Fund 28. And keeping it very briefly, the thing that it does is that it assesses the amount of investment interest by our investors. So if you think about it, this is a very simplistic way of using the data that we have at the moment, because it's too early on to have successful outcomes. We have one exit, but it's still really early to have the data that we need. But the data that we have on the platform in real time is investment interest, the investor appetite for that specific deal. And what this means is that we're using an algorithm, we can basically, and we are doing, automated investment on the back of investment decisions made, not by one fund manager that will tend to have their own bias, natural bias, not by an investment committee that might be 1, 2, 3 people that will tend to groupthink a little bit, because that's just natural, but by people that are investing online, not knowing each other, and most importantly, they're making their own investment decisions on their own money. And they effectively are becoming the fund managers, because it's their data, it's the data that they are contributing with unknowingly, just purely by investing online, that is contributing to the algorithm of the fund that then invests online. So this added information, this added transparency, this added data, it really brings me to the other things, the other two things that are really missing to have a phenomenal market for early stage investment, and that will go all the way up to late stage in the next 3, 5, 7 years maximum, which is speed and efficiency. And that will, and really where that comes, the speed and efficiency, because in order to have all this data, effectively, what fintech needs, what crowdfunding needs, is the liquidity. People buying in and out of companies so that that data is generated. And that really brings me to the topic that I'm sure it will be covered extensively today, which is ICOs and blockchain. Right? And I'm still skeptical about ICOs. I think that the impact in the short term is massively being overestimated. However, I also think that the impact in the long term by the naysayers is being massively underestimated, because it's not so much about the hype of the ICOs that is interesting, right? The really interesting part is the technology behind it, it's the blockchain side. And it's not about, in my opinion, in this case, it's not about the cryptocurrencies, it's about tokenizing securities. So having a token that represents a share. Now, if it means that it's much, much easier for early stage investors to buy into a company and then 2, 3, 4 years down the line, exit that company to another type of investor that prefers later stage companies with a lower risk but a potential lower return, then what that means is that we start having a huge amount of data. We're still having a really liquid market. We still start having a phenomenal market for companies to get investment early on, start succeeding, early investors get out, late investors come in, and really start refreshing and recycling that capital into early stage companies once again. And that's really going to help what has been in the past about 18 months, has been a big topic, particularly by Sherry Kutu on the scale-up and scale-ups in the UK, which is allowing these companies to move on, to grow, to go to the scale-up stage and really carry on going. And not necessarily going into IPOs. So that's where the blockchain really comes in, is that if all of this is already working on a very early stage, that means there's no reason why it shouldn't work on a later stage. If anything, there's more reason to work on a later stage. And just like crowdfunding is now, where it became, it was deemed as not possible initially by business angels, then VCs. Both of those now operate in these platforms. And now in later stage institutional investors that tend to be very traditional, tend to be very risk averse to new technology. But the fact is, if there are good investments in there, if there is the liquidity, if there's the efficiency, if there's the cost reduction and better returns, then these institutional investors, that's really where they will be. And that will start causing, beg the question on which companies will IPO on the London Stock Exchange or any other exchange across the world, when actually they already, in many ways, they're already listed on blockchain, or not listed on a stock exchange, but listed based on blockchain, and that liquidity is there already. So really, the way that crowdfunding is, in my view, going to change in fintech is really keep on evolving, keep on using technology to make it far more efficient, and really to become these data platforms that will allow the entire equity journey by a company to be catered all the way from idea, all the way up to IPO, or just stay as a blockchain, so basically tokenized securities, and have the ability and that liquidity that allows institutional investors to come in and buy the early investors out. And the conclusion is, don't overestimate the impact of blockchain in the short term, but don't underestimate it in the long term. It's a phenomenal technology. It's a technology that is going to help hugely on the equity finance life of a business. And it's something that I see that is absolutely going to be a game changer in the long term on how companies operate. Thank you very much. Hope you enjoyed it. Thank you.